All right, you ready, Jesse?
Yes, sir.
All right, welcome to the SRS segment this week. Our special guest we have today is Jesse Hantla. How we doing, Jesse?
What's up, Mike? How are you?
Awesome, dude. I love the set. I love the lion picture back there. The family, like, you came prepared this week, dude.
Thanks. I appreciate it.
Absolutely.
Lots of work into the home studio to make sure it's professional for my clients.
There you go. Well, that's awesome. Well, thanks for joining us, dude. And this, this SRS segment has been real huge over the past few weeks. Like, we've really been trying to revamp this training just to give you guys, everyone watching, the best training possible, so you can understand, what to do, what not to do in the home, and so Simple Retirement Solutions. We're going to dig into IULs a little bit this week. I know a few weeks back we did kind of IUL basics, but Jesse has been a top SRS producer the whole time he's been here at FFL, and what we're going to talk about today are just different use cases for IULs. I'm sure you guys have probably heard tax-free retirements, one of the big ones, right? So we'll break that down a little bit, but there's also plenty of other clients or situations where it makes sense for college funding, for all kinds of things. So I'm gonna ask Jess some questions he's gonna dig into and do our best to explain to you guys when and why to use these products, and how they can be beneficial to your clients. So Jess, let's hop right into it, dude. So we'll start off with the tax-free retirement. If you can, in a nutshell, I guess, just if I'm your client, Jesse, and what would you see or what would you hear in your appointment where you say, you know what, I think an IUL with some tax-free retirement concepts would be good for this client? How do you get there?
It's just by asking the right questions and kind of leading there, depending on the age, time of their life, their current situation, what they're looking for in regards to their overall goals today, tomorrow, 5 years, 10 years, 20 years from now. And not all IULs are the same, so it does depend on what we're talking about. If we're talking about something for a tax-free retirement, then it's engineered and designed a specific way. If we're talking more like Index Universal Life Express, I like to just present those more of like permanent insurance because it's going to be able to utilize more of the cash value to keep the premiums level. So let's say a 70 or 75-year-old that's super healthy can get into a larger phase of insurance where it's not something that's, like just a regular final expense policy. If they want to have the critical, chronic, terminal illness. But Mike, in that situation, so let's say you're a guy, you're married, you're in your 30s, right? And, Mike, what are you currently doing for work?
I'm in construction.
Okay, perfect. Now, are you working in construction or are you a business owner?
I'm working in construction. I'm a general contractor.
Awesome. How long have you been doing that? And then I'm digging into the report a little bit, right?
Yep.
And then because of the occupation, I like to kind of look where they're at personally, right? Because general contractors tend to make pretty good money.
Yep.
A guy working at McDonald's may not be a good fit for an IUL. Right. Can he get one? Sure. It's just we're going to be designing it on a much smaller portion. But once I've gotten there, then I'm just going to ask into it, what are some of your goals in regards to your future? Do you currently have a retirement plan now? Do you have something for 10, 20, 30 years from now that's going to be able to give you a tax-free retirement? No, well, my work gives us a 401k. Got it. And now that I know that they put money in towards their future, I might be able to navigate them if I can get the right information in front of them, because I personally don't think a 401k is a great retirement vehicle. It's not safe. Nothing there is to protect it. You get taxed on your portion, the employer's portion that they give you as a bonus or their contribution, and the growth, and you're getting taxed on it, and nothing's there to keep you safe. So I like to see if I can always re-navigate that money towards a tax-free retirement play, like an IUL, or if they need liquidity sooner, I'm going to be navigate them towards like a whole life. So
got it. So most clients do have some type of 401k, right? That's about the extent of their retirement. So you find out client has that. Outside of that, there's nothing really going on for retirement. And through there, he's going to maybe express, or you're going to ask some questions like, what else do you have? What are you going to do when you retire? So when you get, I guess, what are some answers that you're going to receive from this client where you go, tax-free retirement, IUL seems like a good fit. So I guess from that point, after you get all this information about the job, what are some telltale signs where you know that's the route to go?
Once you find out what their income is, how much they're paying, the mortgage that they have on their house, that they put extra money towards the mortgage.
Yeah.
It would be kind of like a similar ideal client that could qualify for like a cashback option.
Got it. Okay.
Right?
So once we're there, how do you explain that?
So if I'm there, it's really just I'm either doing a cashback option or I'm doing the IUL. And that's kind of how I look at things, because if they can qualify for a cashback option and they can afford a cashback option, I might flip it into an IUL, because now we're talking something that's going to give them a higher yield of interest. But the way to explain it, so once I'm there, Mike, there's a program out here that could give you a tax-free retirement. You participate with the market. And the way that I design it, Mike, no matter what's happening within the market, you're always going to get a return. Is that important to you?
Yeah, absolutely.
Okay, perfect. And the cool thing is, if the market ever barrels out like it did in 2008, you never lose a dollar. And do you think you could afford to go through another 2008?
No, I don't think any of us can.
I know. I'm still recovering from it. And I like to get on their level, because I mean, I'm totally not affected by that right now, but I want to get on their level. Yeah, it still affects me to today. I'm like, I got PTSD just thinking about it. They're like, oh my God, me too, right? Now, once I've gotten there, now that's the pain point. You don't want to re-experiencing that. So now I've got some play. I've got the pink elephant. I got the bunny in the room. So now I know what I can pull on, right? Now, Mike, in regards to that, let's go ahead and show you how this program works. And, I just kind of draw it out on a notepad a lot of times, where I'll just show like what a stock graph could be.
Yeah.
And I'll say, this is what your current retirement looks like. Do you want to be here? And they go, no. And then I draw one line at the bottom, says 0. And then I start to just mimic the lines of what an IUL would do. So it goes up, the market goes down, I make a flat line. Market goes up, I make a line up. Market goes down, I make a flat line. I say, would you prefer this to be your retirement? They say, yeah. Okay, perfect. Pretty simple. Because I want to talk about it conceptually before I'm even getting into an illustration. I love to get the buy-in before an illustration there, because an illustration is just kind of like the cherry on top, right?
Yeah.
And the plus side is I like to undersell what the illustration will do. Because a lot of these illustrations, man, the numbers look incredible.
Right.
Like it's, if you even say like remotely, this is what your retirement could look like, everybody's going to get one. Right. It would be silly not to, right? But if you underplay it, so I'd rather underpromise, overdeliver. And so a lot of times when I'm building these illustrations out to show the clients, I'm dropping the actual interest rate down. So if I can get them on a buy-in on a lower than the illustrated rate, then they're going to go, oh my God, that's amazing.
Yeah.
But
got it. So at what point do you start talking about the tax-free part and how that, because I mean, you say that, I'm sure people are intrigued, right? A lot of people, I would assume that they don't believe it, or it's too good to be true, right?
Every person says that.
So once you're going through absolutely. Once you're going through the illustration, when do you start talking about loans and how that works and how much money they can expect at retirement?
Yeah. So a lot of the times when we're just talking about loans or leveraging the cash accumulation later, is once they kind of have an interest on what this is, because the main difference is if you're comparing it from a cashback option, you get just 100% of your money back, or we could have excess, right? And they go, well, what does that exactly mean? Right? That means that you can actually borrow money. So if you wanted to buy a car, you wanted to invest into a business, you want to put your kids through college, you wanted to buy something in 10, 20 years from now, you could do it. Once the cash accumulation is there, you can leverage against your death benefit tax-free. Because what you're going to be doing here, Mike, is you're going to be loaning against the death benefit, but you do have to have cash there. So it will take some time for it to compound. Yeah. But you could agree with me, Mike, that wealth is something that takes time, right?
Yeah,
it doesn't come overnight. And Mike, have you ever heard of the eighth wonder of the world?
No.
Yeah, it's called compounding interest. So those that know about it have it, and those that don't pay for it. Where do you stand?
I don't have it. I guess I'm paying for it.
Yeah. And that's something that happens very, very common when we're talking about fractional reserve banking and when we're talking about what the actual banks are doing with their money, where they invest it into life insurance. You know, banks are using that money to put it into life insurance through whole life vehicles. And on top of that, we get to take advantage of long-term tax-free retirement placed through an IUL. Would that be something that you would want to take advantage of as well?
Yeah, absolutely.
And now we've got buy-in. Yeah. Now it's just a matter of getting an application in. So,
got it. I guess what in your opinion, is the biggest hurdle, speed bump to overcome for a new agent in this process? Do you think that they don't explain it properly? Do you think that they don't understand to get buy-in? What do you think the biggest pain points are for someone who's struggling with that?
They're pushing too hard. They're thinking about their own commission.
Yeah.
Depending on how it's designed to, a lot of I'm not saying this happens here, but this is the way I was personally trained at the first company I was at. Yeah. Sell it on target, get the max death benefit for the client for the lowest premium, and then the policy lapses and client's mad, and it's just a snowstorm. So
yeah. So you got to put your client first, like in everything else 100%. That we do here. If you put your client first, put your commission and your sale, everything else secondary, put that first, you should be fine.
Yeah. And I was literally thinking about that on the way to the gym. I was like, I was thinking, Jesse, I'm really proud of you, because in so many times you could have taken the road for yourself, but you always put your client first. Yeah. And because I was thinking about a case that I just did, it took me 3 months to get it issued.
Wow. And
I spent hours and hours and hours on it. And I make more selling final expense on this specific type of case.
Yeah.
And I was just but the way that I designed it for this specific client, as long as he continues making these premium payments in the next 5 to 10 years, he's going to be able to leverage some good amount of dough.
Yeah.
And he's going to be pretty pumped and excited. But, I think about that. And I was just wow, you could have gone this direction and taken it for yourself.
Right.
And I've seen this happen at so many past agents, because I replace those policies all the time.
Yeah. Yeah.
You run into them. But Mike, the cool thing is once we are setting those up, if we are talking about tax-free retirement, you want to use minimum death benefit max cash.
Okay.
And in some cases, you can use the balanced death benefit. Say National Life Group's got 3 options on there, what makes it easy.
Yeah.
One's going to be minimum death benefit max cash, balanced death benefit, and then target premium.
Got it.
A lot of the times what I'll do is I click on target to kind of see what the max is, and then I scale back. So that way I understand the region of how much I can fund it at.
Yeah.
And anytime that you're funding a tax-free retirement, and a lot of times people aren't grasping this, and it's easy to overlook, right? When you're looking at what the target premium is, and then there's a guideline level premium. So this is getting a little bit more into design case.
Yeah.
You want to make sure that the guideline level premium is getting funded, because that's essentially max funding it, or up to the non-MEC max limit. So that means that it's a maximum you can get into it within the first 7 years. Guideline level premium's a maximum before it becomes a MEC, modifying endowment contract. So that means if it becomes a MEC, it becomes taxable. So what I like to do is fund it up to that amount. So I might have to scale the amount of insurance that I'm getting into the client even back further than what the minimum death benefit max cash says, because that's talking about it at that more of that peak funding around target. So I like to get it closer. So if they say, Jesse, I can do $1,000 a month. So I go to minimum death benefit max cash, put 1,000 in there, and it gets it to me. Now, if I see I still have more room to the guideline level, then I'll decrease it on the amount of insurance to make sure I can get that amount in. And then it's max funded.
Yeah.
And when you do it...
Sorry, real quick, because the idea is you want to... There's 2 buckets. We've talked about this on here before. There's in an IUL, there's 2 buckets. There's your cost of insurance, and then there's your investment, your cash value, however you want to look at it. What you're trying to do is maximize that part of it as much as you can, with, like you said, avoiding it becoming a mech. So you're messing around with the death benefit because when you're doing this tax retirement, the death benefit is not the most important part of the policy, right?
Exactly.
Like, it's part of it.
Icing on the cake.
Absolutely. So you're playing with that dial so that we can invest as much as possible with avoid it becoming a mech, but still have enough life insurance to offset any loans or balance or whatnot.
Yeah. And the other thing too is, it's one word I like to be very cautious on talking about when we're talking about anything that's insurance related. I try not to use the word invest, right? Because if we're talking about an investment, we're talking like stocks. We're talking about buying a house, right? Like we're purchasing insurance, or we're leveraging tax codes. That's what I like to talk about. Yeah. You know, leveraging IRS tax codes, being able to compound interest tax free, leveraging other people's money, because like you mentioned, we've got bucket A, which is death benefit, living benefit. Bucket B is going to be your cash accumulation. Yeah, absolutely. So, and the cool thing is depending on the carrier we're working with, like National Life Group has a balance sheet benefit rider that you can put on, and it can give you access to higher amounts of liquidity sooner. So that's something that a lot of people may miss, because most, or actually all, universal life policies are going to have what they call as a surrender charge. So surrender charge means money has to sit there just like in a fixed indexed annuity for 10 or 15 years before you have access to 100% of it. Yeah. But if you put that balance sheet benefit rider on it, you could put like 25, 50, 75, or 100%. And if you put 100%, that means that if he's got $1,000 liquid cash in there day one, he can pull out $1,000 and borrow against the death benefit. Got it. Super cool, right? Absolutely. Well, that's awesome, dude. I want to touch on, before we wrap, you mentioned something earlier about an IUL that you were using for some type of permanent coverage. Would you say, so, I mean, if you're selling IULs, is the tax-free retirement predominantly the reason why you're selling? Would that be the number one use case? Yes and no. Okay. I think it really just depends on the age of the client and their goals, right? If I'm running into final expense type clients, 60s plus, super healthy, I'm going to go with like an Index Universal Life Express with Moo. Can't wait for America to release theirs. So if you can do any pushing, if you can do any pressure with Sean, I'll see what I can do, bro. I'll talk to Sean. We'll see what we can do. But those are your two big use cases, right? And then so let's wrap with that. Let's talk a little bit about that. Right now, it's the Moo product. But when are you using that, and how are you talking about that? What I guess in that appointment, what makes you go there versus the final expense? They're healthy. They're super healthy. Yeah. They want, $75,000 or $100,000 of insurance. They've got the allocated amount of money. Yeah. They might still be working, or they have a retirement that is already giving them lifetime income, like from a pension. They're distributing income out of their 401k or IRA, working part-time. Social Security is high. Doesn't have a lot of bills, but they have a lot of need that they want to leave behind to their loved ones. Or, a lot of it just boils really down to health. Like if you had a heart attack or cancer in your past, I can't even think about going term or going towards the direction of an IUL Express. Yeah. But let's say if, Mike, we're talking and you're 68. Yeah, Jesse, I've never had any medications. I work out all the time. I make about $3,000 a month. All right. You're probably an ideal client. Got it. And the thing is if it doesn't fit today and it doesn't make sense for tomorrow, and I wouldn't put my mom into the program, I'm not going to recommend it in any way, fashion, or form. Yeah. And lately what I've been doing, I use, because a lot of people are in the country right now are getting hit pretty hard. So I break it down between either 2 or 3%. So it's 7, 5, and anywhere between 2 and 3% of what I end up giving them their three options on. Got it. Right. If the 2 or 3% is like $26, I'm going up to the 3%. You know what I mean? Got it. And you're saying this is the percentage of what they're bringing in for monthly income? Yeah, monthly income. Yep. And unless they're like super high net worth. Yeah. I got a guy who started an IUL last year. He was jumping 120 grand into his personally. Okay. I mean, but that's max funded.
Yeah.
So like he's paying an additional $50,000 or $60,000 on top of what the base is, right? But he just called me the other day. He's like, Jesse, I want to start up another one. What does that look like? In his situation, because he's got a lot of income coming in through businesses, business is leveraging it. I don't really put a cap on that. I let him tell me where he's comfortable. You know what I mean? Because if he's making $1 million plus, like, and he wants to dump in $300K, I'm not going to tell him no.
Right.
You know what I mean?
Yeah, absolutely. I mean, it's going into a safe product. Yeah,
better than I do.
Absolutely, absolutely. So it sounds like, I mean, this would be great for one of the big struggles with a lot of agents early on is I got my mortgage protection client 68 years old and he wants $200K, right?
Yeah.
And a lot of times, I mean, depending on the carrier, what you can't. Now, what you're saying is health wise, if they're in the right health, so they have to be in good health. If they're in good health, we can do something with an IUL Express through MU and again, eventually the America one, where we can give them essentially what they were looking for, but it's just not a term policy. Exactly. And I guess how are you structuring that like a term to where it does expire at time? Are you trying to get them a permanent coverage? What normally happens in that situation? I just set it up with the Express. Yeah. Keep it easy, Express, because on the illustration, it's contractually says it's, I think, guaranteed for, depending on the age, anywhere between 13 and 15 or 20 years of coverage. Yeah. So it acts as like a term, on its own, pretty much. Exactly. But then it shows you on the illustration where it's got the guaranteed, the assumed, and then the current, right? Yeah. And then the current shows that if it gets that, it'll never expire. And the average rate of the current was like whatever it is, 5.87 or 5.65. But if it continues to get that every single year on average, the policy never expires. Yeah. So I like to, again, kind of go under it. So use the middle column. So look, this is what we look like. If you're really concerned with it, I recommend put another $50 into it every month. Yeah. Put another $10, $20, So that way you can always add a little bit extra. It's like paying off your car early. Your car payment's $380. You put $400 in, you get that little extra juice, and it'll help it compound some more interest. Absolutely. So, but in this case, it's positive for you, not just getting rid of the principal. So yeah. But yeah, so we've got the tax-free retirement play. We've got the permanent life insurance coverage, and big basis about it too is, if people want to go towards more of a permanent play, and this is kind of a cool trick you can use, is if you're working with a carrier like National Life Group, let's say someone today, they've got a lot of bills, right? They got children, married, mortgage, get them a large term, right? A real big term, let's say for $1 million, $2 million or whatever. And then it's a 20-year policy. I believe you can convert it within 15 years, if I remember right. Yeah. So then kids are out of the house, then they convert it into a permanent policy, but they're also converting it at today's age, today's health. Right. So it may not be planting the seed, like it's planting the seeds for the future. And I feel like a lot of clients, because you're not pushing them to oversell them, man, I've been getting referrals like crazy just because of taking that little extra amount of effort and not going, hey, we need to do an IUL today. You need to do this. It's, hey, let's start with a term, get the ball rolling, get you comfortable in the next year or two. And I've already converted a couple people out. Yeah. Or I'm in the process of doing that right now. And it's super cool to see, because now they're calling me saying, Jesse, I got the money. I'm ready to convert it. What can I do? Yeah. I want to take advantage of what's going on. That's awesome. And that goes back to, Sean used to say this to us, become their guy. Like, it's not just I sat down with this client, sold him a policy, and then I'm just off to the races to the next one. Like what the client you were talking about earlier, where you said I could have just sold him a final expense, so would have made more money on it. But you sold him this IUL, took 3 months to get placed. But you mean to tell me that guy's not going to give you referrals or call you back for other business? Like it helps you become their guy. You're going above and beyond. And this is not what our clientele is used to. They're used to the one and dones, right? Come in, write the policy. All right, see you later. And there's usually no follow-up. I mean, a lot of stuff you're talking about, if we can all utilize our book of business properly, our past clients, I mean, think about if I don't care how much you sold last year, you still have dozens on top of dozens of clients that you helped, and their needs change year in and year out. Why are we not going back after a year or two and going, hey, I helped you out with the term. What's life like? I mean, they may want the term still, may want to add something to it. Like you may want to convert something, but there's so many opportunities for improving your client situation again, and also helping you out with your own business. Like, and these products, I think these help solidify that client for life type of deal. And we as a whole need to do better at getting out to them repeatedly. I mean, it's like
100%.
It's like leads are a blessing and a curse, because you become a lead junkie real quick, right? New leads. It's like, dude, what about all those leads you had? What about those clients you had? What about the referrals you didn't get from those clients?
Yeah. And I'll be transparent. When I first got here, it was like lead.
Yeah.
Just buy more. And I look back and I'm like, I got 1,000 plus clients, right. 1,500 plus clients that are sitting there. I don't need to go buy. Like, why don't I call 50 clients a week?
Yeah.
And I might be able to convert something. And most of the time they're like, yeah, Jesse, I just retired. Hey, I've got this money it's within a 401k. What can I do with it?
Right.
Well, I can help you with that, you know?
Absolutely. Like, what if before you called your leads, you went through your old clients? We're not saying don't buy leads. I mean, by all means, new clients. I mean, there's plenty of people filling them out that don't have insurance, underinsured or whatnot, but why not do both? Like, I remember vividly, it was a different company. Comp wasn't the same, whatever, but we all, Sean, myself, every week, a handful, maybe 2 or 3 of our policies were from a repeat client. We're from someone, a referral. We're from a type of annual review or whatnot. Yeah. It wasn't, I'm not saying you're going to write all your business off that, but if 90% of our business were new leads, 10% of it was repeat clients, referrals, annual reviews. I mean, it's business sitting there, and the clients need help. I mean, it's like and I think it's that you talk so much, like, you do care about your clients. You put them first. If you truly put your clients first, you'll go back to your clients and see if they need some additional help, see if they need to be moving to another product. Because life happens. It changes like this. So I was out there last year. They were fine. You don't know what happened. They could have lost a family member. They could have had another kid. Well, who knows? Could have got a better job, and now they have more money to invest. I mean, you never know. But I would make sure you're supplementing whatever you're doing with your book of business.
It's huge. But then, and you're talking about that, you said 10% per week.
Yeah.
And you compound that over 52 weeks.
Yeah.
I mean, that's a ton of clients that you didn't have to buy leads for.
Absolutely.
So, I mean, I would definitely recommend blending it in, and that's huge. I could make a big impact, maybe push you over the edge to hitting Hall of Fame.
Absolutely. Yep. No doubt. Dude. Well, hey, I appreciate you doing this, man. This is awesome. I
appreciate you having me. It's always a blessing to serve the team, serve the company. And, it's like you just said, mission over commission, and we're all going to win. We just keep getting bigger and better.
No doubt. Well, thanks again, guys. Thanks for watching. If any questions on this, please let us know. Drop them in the comments. Shoot us an email. We'll get Jesse to answer them offline, and we'll talk about them next week if there's anything that you want some clarity on here.